Okay, this question says, the following draft consolidated financial statement led to Bakoki Limited Group consolidated statement of income for the year ended at 1st July 2018. We have revenue, cost of sales, gross profit, distribution cost, administrative, income from interest in associate company, profit, operating profit, profit on disposal of tangible asset, income from investment, interest payable, profit before tax, income tax, profit after tax, non-controlling interest equity, profit attributable to members group, dividend paid, retained profit for the year, Then we go to the balance sheet. Always in a cash flow, there will be two balance sheets. The balance sheet of the current year and the balance sheet of the previous year, so that we compare the movement of cash in and cash out. Therefore, here we have non-current assets, tangible assets, intangible assets, inventory, investment in associate company, other investments. Then current assets, we have inventories, trade receivables, cash, and bank balance. Then equity share, ordinary share capital, share premium, retained earnings. Non-controlling interest, we have it there. And non-current liabilities, current liabilities. Then additional information. Number one, Bakoki Limited has two wholly owned subsidiaries in addition, In addition, it acquired 75% interest in Nyange Limited on 1st August 2017. It also holds 40% interest in Pirika Limited, which it acquired several years ago. Goodwill has not become impaired. Now, we say that in a cash flow, either there will be acquisition of a subsidiary or disposal of a subsidiary. As you can see in this question, there were disposal of shares in the acquisition, sorry. We acquired Nyange Limited. We acquired Nyange Limited as a subsidiary. Therefore, at this point in time, you find that either cash flow will be acquisition or disposal of a subsidiary. Number two, the following are the fair values of Nyange Limited at the date of acquisition of its shares. Now, examiner is giving us the net assets of Nyange Limited. Remember, we said that when you acquire a subsidiary, any transaction you are making, you include the subsidiary acquired. You include the subsidiary acquired. If you are determining the amount paid to purchase asset, you also incorporate the asset of the subsidiary acquired. That's why examiner is giving us the net assets acquired there. The net assets acquired. Then we go to note number 3. Under net assets, we have land and equipment, current assets, inventories, trade receivable, cash and bank balance. Current liabilities included a corporation tax of 34 million. Then we have share capital, retained earnings there. Then number 3, the consideration for the purchase of the shares of Nyange Limited comprised 44 million ordinary shares of shillings 10 of Bakoki Limited at a value of 550 million and a further payment of cash of 28 million being made in cash. Number 4, the tax charge in the consolidated income statement is made up of the following. That is the tax charge for the year: corporation tax, deferred tax, tax attributable to associate company. Then the tangible non-current assets of Bakoki Limited group comprise the following: cost or valuation. As at 1st August, we have them with additions during the year, disposals during the year, depreciation as 1st August, it was there, charge for the year, examiner has given us charge for the year, disposal during the year, coming amount as at that 1st July 2018, examiner has given us there. Number 6, included in additions to plant and machinery are items totaling to 1.7 million acquired under finance leases. The plant and machinery disposed of during the year resulted in a profit of 300 million. All these rentals were paid on their due debts, Number 7, non-current liabilities comprise the following: obligation under finance leases, 6% debentures, deferred tax. Then number 8, there had been an issue of debentures on 1st August 2017. The par value was 3 million, but they were issued at a discount of 100 million. The effective rate of interest is 7%. Then number 9, current liabilities comprise the following: we have trade payables, obligation under finance lease, corporation tax, accrued interest. Then required consolidated statement of cash flows for Bakoki Group for the year ended at 1st July 2018 in accordance with the requirement of International Accounting Standard IAS 7 statement of cash flows, 20 marks. Now, I said yesterday that you attempt this question. Thereby, I believe that you did good and attempted. Because if you don't attempt and Malim is coming to do it, then you find difficulty following it up. But if you attempt it, you will find that it will flow very well. It will flow very well because you now wonder, how do I account for this item? But you find that Malim will be doing it. Therefore, you understand this is how I should do it. Like why I mentioned this question early is that the examiner included a lot of items to be computed. Now, if you include a lot of items to be computed, it needs to be very much keen when you are doing them. Now, when we are doing cash flow, we said we have two methods. We have the indirect method and we have the direct method. These two methods only differ in operating activities. Under operating activities, that is where they differ. Therefore, I want us to use this question to do the operating activities, to do the using indirect method. Therefore, we say Bakoki Group. You say Bakoki Group, statement of cash flows, for the year end 31st, July 2018. That 1st July 2018. We start with cash flow from operating activities. Cash flow from operating activities. We say shillings in millions. We put 2 columns of currency there. Then we begin with, of course, when we are doing indirect method, we use the net income approach, where you begin with profit before tax. And always this is a free mark. Because I just go to my income statement, I check profit before tax. Of course, the examiner is very much gracious to us. He has given us 4015 from the income statement. Therefore, I already have 1 mark there. Then I adjust by non-cash items. I believe I showed you all non-cash items or any adjustment, how you do the adjustments. When the question is silent on the method to be used, what method is most preferable, Mwalimu? The most preferred method is the indirect method. That is the most preferred. And in the indirect method under operating activities, it has a lot of free marks. But when you go to direct method, unless you are very keen, those 3 items, you might miss all of them. Those 3 items that we did yesterday, unless you are very keen. I'm not saying that don't use it, because you need to revise on it. You can go to an exam, examiner wants the direct method. But if the examiner is silent, kindly go for indirect method. What we are doing is the indirect method. That is the most common. Therefore, here we start with number one, depreciation. Depreciation. Now, depreciation at some time examiner will give you or examiner will not give you. Like when you check in this question, under note number 5, note number 5, tangible non-current assets of Bakoki Group comprise the following. We have additions, disposals, depreciation there. Chart for the year, we have building, land and machinery. Total is 650. Note number 5, total is 650. Examiner already gave us, but also in our first question, I showed you how to get it if examiner has not given you. It will still remain. I showed you how you get it if the examiner has not given you. But if examiner has given you, don't waste time calculating. Just pick it, like in this question, note number 5, chart for the year. In the building is 250, in plant and machinery 400, total is 650. Then you have it there. Then we come to item number 2 is impairment. Impairment loss. Now, impairment, you compare goodwill. Therefore, we go to our balance sheet. Is there goodwill? Balance sheet. Is there goodwill? There is no goodwill to compare. Therefore, it means that I don't have impairment. I put a dash, but I showed you how to get it in our first question. If you want to pass this exam, make sure those workings are relevant to you. We did not waste time on them. Make sure they are very relevant. If they are not very relevant to you, then I believe you need to struggle much. But if you use them as relevant items to you, it will help you. I already showed you if it was not given how to get it. You compare goodwill. But in this question, there is no goodwill to compare from the previous, or we acquired Nyange Limited. If the examiner has told you that we acquired Nyange Limited, this was the goodwill, this was the impairment, then you report that impairment. Then we go to amortization. Amortization, you compare intangible assets. I already showed you amortization, you compare intangible assets. From the previous year, for example, it was 2,500 to 2,800 in the previous year. Therefore, if intangible assets are reducing, that is where we get impairment. When we check in this question under non-current assets, we have intangible assets. In the previous is nil, dash. In the current is 200, which means there was no impairment. I put a dash. Like that. Then I move on. I go to the next item is finance cost. Finance cost you get it from the income statement. My income statement has what? Finance cost, income statement. Interest payable of 300. I put it there. You move on. You just get it from the income statement, finance cost. Therefore, you get free mark there. Then we go to anything from the income statement that comes before profit after tax. Anything in the income statement that comes before tax, profit before tax, anything. Therefore, we go in our income statement, we have income from associate. That is profit from associate. Profit from associate. We have it there as how much? Profit from associate. Who can give Mwalimu? Profit from associate. Is that 990? 990? That one we less. 990 we less. Profit from associate. Then also in the income statement, before tax there is profit on disposal of tangible asset. Profit on sale of asset. Profit on sale of asset. Before tax, we are looking at items before tax, 300. Any profit you less, any loss you add. 300 there, 300 there. Then also we have income from investment income. Investment income, we have 80. We have 80 there. That is before tax. That is item before tax. Item before tax. We are considering the income statement. Then in the additional information, if you sold any asset or anything happened that necessitates additions, you do it. Therefore here, I believe when you take from revenue to profit before tax, those are the items that we add back. Therefore we say cash flow before working capital items. Cash flow before working capital items. You help Mwalimu there. You give me totals there. You give me totals there. You give me totals there. Don't wait for Mwalimu. You give me totals there. That 595. I don't know if you are getting that. That 595. Those are the working capital items. Then I come to working capital items. Number one is inventory. In inventory, we have receivable, then payables. Therefore, let's begin with inventory. Let's begin with inventory. Let's begin with inventory. Inventory, you are going to take your opening balance, that is from the previous balance. Inventory's previous balance was 2,000. 2,000 plus subsidiary acquired. Which is we acquired Nyange Limited. Inventory was 64. Then you compare with the balance at the end. Balance at the end is 3930. That 930 balance at the end. Therefore, I will take 2,000 opening balance plus subsidiary acquired. I get 2064. When I compare 2064 with that 930, it is increasing with how much? That 930, 1866. 1866, but it's an increase, we less. An increase, we less. We go to receivable. Receivable previous balance receivable from the balance sheet. 2550 plus subsidiary acquired 56. Then you compare with what you have at the end, receivable that 700. That 700. You compare with what you have at the end, that 700, that is 2550 plus 56. 2606. When I compare with that 7, that is 1094. 1094, but it is increase, we less. 1094, increase, we less. Then we go to payables. I believe you are following. Payables. Now on payables, in the balance sheet, we just have current liabilities. But when we go to additional information, note number 9. Note number 9, we were told that current liabilities comprise the following. In the opening balance is 960 plus subsidiary acquired. Payables, current liabilities, including corporation tax of 34. Therefore, it will be 170 minus 34. When you take in additional information, 170 minus 34, 136 plus 136. Why am I taking 136? Because when you check the subsidiary acquired current liabilities, including corporation tax will go to the tax account, therefore we exclude it. Then we compare with what we have at the end, which is at the end we have 1600. 1600, that is note number 9. Note number 9. Note number 9. That is 960 plus 136. 1096. When we check at the end, is increasing 1600. I'm getting 544. Increase. Increase is a cash inflow. Increase in payables is a cash inflow. Then we get our total after working capital. We get our total after working capital, which is 3595 minus 1866 minus 1094 plus 504. Mwalimu is getting 1139. 1139. 1139 there. I don't know if you are together with Mwalimu. Then we come to less finance cost paid. And also we come to less taxation paid. Taxation paid. We come to less taxation paid so that we get our net. Are we there up to that point, my good friends? Are we together up to that point? Thank you very much. I can see many of you, Ruth, you say we are together. Thank you very much for that kind response. You know, it's good to respond to Mwalimu. It's good to respond to Mwalimu. Online is not easy. You might be teaching yet people are not around. Therefore, it's good to respond and also to ask questions like what our good friend Florence does. I like it very much what our good friend Florence does, because if you interact with Mwalimu, you get to understand the concept more than just to listen, keep quiet, listen. Okay, let's go to finance cost paid. Now, finance cost paid, in the income statement, we have 300 that we charged here. Is it what we paid? When we check in note number 9, there is accrued interest, accrued interest. We have 2018, 2017. In 2017, accrued interest is 60. In 2018, it is 80. In 2018, it's 80. Therefore, it means that we are going to compute that item. I will take the balance brought down, which is interest. That is 60, sorry. Then I add subsidiary acquired. I check in the subsidiary acquired if I acquired interest. There is nothing, I put it out. Interest for the year from B and L, it is 300. Then whatever I get is 360. I come to compare with balance carried down. Now, when we come to balance carried down, it was a bit complicated. Let me show you, it is not 80. Balance carried down is not 80. Why? Let's go back to note number 7 and 8. Note number 7 and 8. I will show you why the balance carried down is not 80. Why the balance carried down exactly is not 80. Using note number 7 and note number 8. How am I going to use it? In note number 7, the examiner says the non-current liabilities comprise the following. We have obligation under finance lease, 6% debentures, which is 29.93, then deferred tax, which is 60 and 26. Then note number 8. There had been an issue of debentures on 1st August 2017. The bar value, now we issued debenture, issue of debenture. Bar value equals to 3 million. That was what we issued, 3 million. Then, at a discount of 100 million. Then I come to less the discount. Less discount. 100. Therefore, it comes to 29. Therefore, cash received or fair value. Cash received or fair value is 2,900. Is 2,900. 2,900. 2,900. But when you check in note number 7, examiner is saying 6% debenture. 6% debenture is 29 what? 29.23. 29.23. 29.23. 6% debenture is 29.23. But remember what we received in terms of cash is 2,900, which means there is an interest that we have not paid. There is an interest on that debenture that we have not paid. How do we know that? Let me show you. Let me show you how we know that. It means that we are going to amortize this debenture. Remember amortization in debenture? If you forgot, then I beat myself. If you forgot, I beat myself. How we amortize debentures? How we amortize debentures to get the current balance at the end. Amortize this debenture, we say here, principal balance, then effective interest, installment, then balance, carried down. We are going to amortize the debenture to find out if what interest is remaining. What interest is remaining? Our coupon payment is 6%. Our interest here is 7%. 7%. Year 1, the fair value is 2,900. 2,900. The fair value is 2,900. Interest 7%, that is the effective interest, is that one. Therefore, I will take 0.07 times 2,900. I'm getting 203. The interest that we charge is 203. 203. And what we paid is 6% on the nominal value, 6% on the par value. 6% on the par value, it means 6% on 3 million. 6% on 3 million, 6% on 3 million is 180. It means that we paid 180. We paid out 180. Therefore, what is the balance at the end? It will be 2,900 plus 203 interest minus 180. I'm getting 29.23. Therefore, it means that I paid only 180 out of 203. Interest of 203, I paid 180. Therefore, the balance of 23, I add. Balance carried down, it will be 80 plus 23, which gives me 103. 103, which gives me 103. Therefore, the interest paid, I will compare 360 minus 103. I'm getting 257. Interest paid. Interest paid is 257. 257. Therefore, I bring here 257. We less 257. Are we together on that? Are we together on that? I know that could be a challenge to many of us, but the reason why we were doing this is to apply them. Remember, we were doing this small topic, not just for fun, but it was when it comes at some point, you apply them, you apply them. When it comes to some point, you apply them. Let's go to taxation paid. Let's go to taxation paid, tax paid, taxation paid. Taxation paid. Taxation paid. Here you take balance, brought down, that is a deferred tax. Current tax. Then you add sub-acquired. Now that we know that we acquired the subsidiary, you add charge for the year. Charge for the year. Then you less tax recoverable. Tax recoverable, you less. Then whatever you get, you compare with balance. Carried down, both deferred and carried. You compare with that. Therefore, using that working, I believe you can give me those figures. Using this question, corporation tax, that one we are getting it in additional information, note number 7. Note number 7, deferred tax is 26, opening balance is 26. Current tax, we get it from note number 9, 434. Note number 9. Remember the breakdown in note number 9 and note number 7. That's why I said yesterday, practice this question. You could have found those items. Then subsidiary acquired. Subsidiary acquired in the statement of financial position of the subsidiary acquired 34. 34. 34. Subsidiary acquired 34. You check the net assets of subsidiary acquired where we have current liabilities including corporation tax of 34. Then charge for the year. Charge for the year we were given in note number 4. Note number 4, charge for the year. Charge for the year, we have 1345. 1345, but we less associate. We lost associate, which is 355. We less associate, that is not our tax, we less associate, note number 5. Number 4, 1345 minus 355, 990. Charge for the year is 990. Recoverable is nothing. Is nothing there. Then balance carried down. We have 60 deferred tax. Then we have 924. Total is 984 there. Total is 984. What about the above total? $1,484. $500. It means we paid 500. Then we get next. From operating net, we get net 1139 minus 257 minus 500, 382. Our A is 382. 382. That is the end of our part 1. 382, the end of our part 1, operating activities. Operating activities, the end of our part 1, operating activities. Any question? Any question? Then quickly we go to item number 2, investing activities. We go to investing activities. If you have no question, we go to investing activities, which is our number 2. Cash flow from investing activities, you underline. Here, I believe we understand which items goes there. Which items goes there? Cash paid to purchase assets. Cash paid to purchase assets. Cash paid to acquire a subsidiary. Cash paid to purchase intangibles. Cash received on sale of assets. In this question, we did not dispose of a subsidiary, but if we have disposed cash received on disposal of SUP subsidiary, investment income received, investment income received, then last the dividend received from associates. Dividend received from associate, then we get the net. From investing, Malim is writing operating. Investing activities. You give me the net there. Now, cash paid to purchase assets. You get it from asset movement. You get it from asset movement. I showed you the working for that. Now, using that working or using this question, can somebody give me that item? Can somebody give me that item? I'm giving you 5 minutes. Can somebody give me that item? I'm giving you 5 minutes. 5 minutes, it's 5:45, 5:50. I'm giving you 5 minutes. 5 minutes to give me that item. Anyone? 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 Okay. When you check in this note number 5, when you check under note number 5, examiner told us that the tangible non-current assets of Bakoki Group comprise the following. We have as at 1st August 2017, then additions during the year. Additions during the year, additions during the year, additions equals to 4,200. Additions is 4,200. Now, out of that additions, Examiner is saying that number 6, included in the additions to plant and machinery are items totaling to 1,700 acquired under finance lease. Therefore, we acquired under finance lease 1,700. Therefore, we less that item. And also in note number 2, we acquired a subsidiary. Plant and machinery, we acquired a subsidiary. Plant and machinery, we less 330. We less 330. We less 330 there. Therefore, what do we have? 4,200 minus 1,700 minus 330. 2170. I can see Ruth, you got it. Thank you very much. 2170. 2170 we less. 2170 we less. Then cash paid to acquire a subsidiary. Cash paid to acquire a subsidiary. Cash paid to acquire a subsidiary there. Cash paid to acquire a subsidiary is in note number. Note number 3. Note number 3. Examiner says the consideration for the purchase of the shares in Nyange Limited comprised 44 million ordinary shares of shillings 10 of Bakokik Limited at a value of 550 and a further payment of cash 28 million. Therefore, cash paid equals to 28 million. That is what we paid. But remember, I said yesterday that if you pay 28 million in cash, you don't report 28 million. You adjust with any bank overdraft or any cash in the subsidiary. You adjust with any bank overdraft or any cash in the subsidiary acquired. Therefore, when you check in the subsidiary acquired, there is cash of and bank balance of 224. Therefore, we come to less cash, which is 224. Therefore, we are getting what? $196. Therefore, we have the cash inflow of 196. Cash inflow. It is not outflow because we received cash of 224, even though we paid 28. Even though I paid 28. Even though I paid 28, but I received more. I received 224. I received 224. I received 224. Therefore, the net cash that I'm remaining with is 196. That is the net cash I'm remaining with is 196. Then cash paid to purchase intangible asset. Cash paid to purchase intangible asset. Now, when you check intangible asset, that is there. Cash paid to purchase intangible asset. When you check in the previous balance sheet, intangibles is dash. In the current balance sheet is 200. Therefore, let's see if it is goodwill on acquisition. Goodwill. Let's test the goodwill on acquisition. Goodwill. Let's first get the goodwill on acquisition of Nyange Limited. Nyange Limited. Goodwill. We take the purchase consideration. Which is 550 plus 28. Purchase consideration. 550 plus 28. 578. We paid 578. 550 was shares. 28 was cash. Then we come to less net assets acquired. Net assets acquired. Net assets acquired, we check in the subsidiary acquired. It was 504. Net assets acquired is 504 times which percentage? We acquired 75% times 75%. $378. Then I get 200. Therefore, it means that intangible asset we are reporting there is the goodwill. Intangible asset we are reporting there is the goodwill on acquisition of Nyange Limited. Therefore, for cash, I put a dash. I put a dash. I put a dash. For cash, I put a dash. I put a dash. For cash, I put a dash. Then cash received on sale of asset. We sold an asset, kindly good friends. We sold an asset in this question in note number 5. Note number 5, disposal, disposal, disposal. Note number 5, disposal. Note number 5, disposal. When you check on disposal, disposal during the year, it was how much? Assets disposed was 1,000. We come to less depreciation, depreciation that was disposed, depreciation, disposed, depreciation in note number 5, it was 200. It was 200. Therefore, carrying amount that was disposed, it was 800. Carrying amount was 800. I'm taking the disposal of an asset minus depreciation. Carrying amount was 800. Then examiner tells us in note number 6. Note number 6. Let's together read note number 6 to see how much do we sell this asset. Note number 6. Note number 6. Included in additions to plant and machinery are items totaling to 1.7 million acquired under financings. The plant and machinery disposed during the year resulted in a profit of 300. Therefore, we sold this asset and we got profit of what? 300, which means we sold at 11. Therefore, I come to say I sold the asset at what? At 11. At 11. At 11. Then cash received on disposal of a subsidiary, I put a dash because in this question, I did not dispose of a subsidiary. I acquired a subsidiary. Therefore, I put a dash. Then investment income received. Investment income received, when you check in the income statement, there was investment income of 80. But in the balance sheet, there is no income receivable. Therefore, it means we received 80. In the income statement, we have 80 investment income. But in the balance sheet, we don't have income receivable. What does it mean? It means we received the total of 80. We received the total of 80. Then dividend received from associate. Dividend received from associate. I showed you yesterday how you do dividend received from associate. I don't know if you remember, but let me just do it without wasting time. Dividend received from associates. You take your balance, wrote down, investment in associates. Balance wrote down, investment in associates. Then you come and add profit for the year. Associates. In this question, there is tax from associate. Tax from associate. There is tax from associate. We less. Tax from associate, we less. Tax from associate, we less. When you read in note number 4, the breakdown of tax, there is tax from associate. That one we less. Then what we get here, we compare with balance, carried down, investment in associates. Now, from our balance sheet, investment in associate, in the previous year, investment in associate, it was 2,000. Profit for the year, you get it in the income statement. associate, although we have it here, profit from associate, 990. Then tax, 355. Tax from associate, 355. Then balance carried down from the balance sheet is 2200. 2200. 2200. Therefore, let me see if I paid dividend. I'm getting here 26. 2635 minus 435. It means we paid dividend of 435. We received, not we paid. It's the associate that paid, but for us, we received dividend of 435. We received dividend of 435. Then we get the net. Net, I'm getting 2170. $359. Net cash flow is 359. 359. Net cash flow is 359. Net cash flow is 359. Then we go to the last section of our cash flow. Last section of our cash flow. Cash flow from financing. Financing activities, here we have issue of shares at a premium. We have repayment, additional borrowings. Repayment of loans. Dividends paid to parent, shareholder, then dividends paid to NCI shareholder. Then we get the net. We get the net cash flow from financing activities. Now, issue of shares at a premium. Issue of shares at a premium. Let's see if we issued shares at a premium. Let's see if we issued shares at a premium. Issue of shares at a premium. Issue of shares at a premium. We check on ordinary share capital. Ordinary share capital. We are comparing ordinary share capital. Par value. Par value. Previous year, par value, ordinary share capital. Previous year, it was 4,000. Previous year premium was 4190. Then subsidiary acquired. We acquired the subsidiary, we issued 550. We acquired the subsidiary, we issued 550. Note number 3, we issued a subsidiary. We issued shares that we add to the opening balance. Then we compare with balance carried down. Par value. Par value was 78. Premium, that is premium is 56, 57. I add, let's see if I issued shares. Let me add 4,000 plus 4190. 87, 40. Then this one is 78, 80. 13, total comes to 13,646. Therefore, when I compare with the opening, 49.06. It means we issued 49.06. 49.06, we issued 49.06 there. 49.06. Additional borrowings. Additional borrowings, we check on loans. But when we go to loans, examiner told us that that is not number 8. There had been an issue of debentures on 1st August 2017. The bar value was 3 million, but they were issued at a discount of 100. Therefore, it means that you take 3 million minus 100, it is 20 what? 29. Therefore, additional borrowing, 2,900. We received 2,900. We received 2,900 additional borrowing. But also we repaid some leases. Repayment of leases. In this question, we repaid leases. We repaid some leases. Repayment of leases. Repayment of leases. I'm going to check on my leases in additional information that is not number 7 and not number 9. Long-term lease, long-term lease. In the previous year, long-term lease, previous year it was 1340. 1340. Then additions during the year, additions during the year, 1,700. 1,700. Additions during the year, 1,700. Then short term. Short term in note number 7. Short term lease, note number 7. From the previous year, short term is 400. Therefore, I get total. I'm comparing the leases. Long term from the previous balance sheet, 1340. Addition during the year on PPE, 1,700. Short term, 400. What is total? That 440. Then I compare with the balance carried down. Long term. Balance carried down. Long term, 1470. Short term, 480. When you add, $1,897. When we subtract, 1,543. That is what we paid. 1,543. 1,543. That one we paid out. 1,543. We paid out. Then dividend paid to the parent. Dividend paid to the parent shareholders. Dividend in the income statement. When you check in the income statement, examiner gave us the dividend of 800. Therefore, we subtract 800 from the income statement. Dividend paid. Dividend paid, 800. Dividend paid, 800. Then we go to dividend paid to NCI. Our last item, dividend paid to NCI. Dividend paid to NCI. Dividend paid to NCI. Here we take balance, brought down, that is NCI, net assets, subsidiary acquired, NCI, profit for the year, or other total comprehensive income, NCI. Then whatever we get, we compare with balance, carried down, NCI. Balance carried down, NCI. Balance carried down, NCI. Therefore, I'm going to compare NCI in the balance sheet. I'm going to compare NCI in the balance sheet. From the previous year, my NCI was dash. There was no NCI. In the current year is 230. In the current year is 230. In the previous year, it was dash. There was nothing. I'm just checking NCI in the balance sheet. Profit for the year. Profit for the year. A subsidiary acquired. We acquired Nyange Limited. 25% times 544. What was the net assets of NCI there? We acquired Nyange Limited. 544 net assets times 0.25. Our NCI is 126. NCI is 126. Subsidiary acquired. We acquired Nyange Limited. We were not given the fair value, but we are just given the net asset that we are going to measure it at partial method or at cost. Then profit for the year, NCI, from the income statement, 200. Therefore, total is 326. I compare with the 230. $96. It means we paid them 96. We paid them 96. Then we are done with our items. We are done with our items. We are done with our items. We get net cash flow. I'm getting 53.67. Net is 53.67. Net is 53.67. After I have that net of 53.67, I come to get net changes in cash and cash equivalents. Net changes in cash equivalent, which means I will take A plus B plus C, which of course I'm getting 382 plus 359 plus 53.67 plus 53.67. I'm taking 382 plus. This one is negative, sorry. This one is negative, therefore we left. 359 is negative. 359 was negative. 359 was negative. 359 was negative kindly because we had paid cash paid to purchase asset 21. It was negative, therefore I will take 382 minus 359 plus 53, 67, 5390. 5390, I get 5390. 5390. Then I come to add cash and cash equivalent. I come to add cash and cash equivalent. I come to add cash and cash equivalent at start. Cash and cash equivalent at start. Cash and cash equivalent at start. I'm checking on cash and cash equivalent. I have that 640. Do I have the bank overdraft? No. Therefore, I come to add that 640 there. That 640. I come to add that 640. I come to add that 640, of which when I add, I get what? 9030. 9030 there. Then I come to check that is my cash and cash equivalent at the end. At the end, that is my cash and cash equivalent at the end. When you check in the balance sheet at the end, we have 9030 there. That is the end of that question. That is the end of that question, group cash flow, and it marks the end of our group accounts and group cash flows. Therefore, I'm very glad that we have completed the group cash flows. On Monday, we meet on Monday. We are beginning on a new topic, which is earnings per share. On Monday, we meet, we look at the new topic, which is earnings per share. Earnings per share. Therefore, we are at almost 85% complete of our syllabus. When we finish earnings per share, we are at 90%. Therefore, make sure you are revising very serious if you want to pass. Thank you for your time today. Let's meet on Monday or at 7 p.m. Thank you. Bye-bye.